All right, everybody. Hope everybody was doing well this evening, this morning, or this afternoon, whether you're watching this, wherever you're watching this. I know we've got people joining us live from across the country, watching us either on Zoom, on Facebook, and if you're catching us on the replays, hey, make sure to type in where you're from so I know exactly what part of the country you're watching this from. If you're from the Phoenix area, that'd be great. If not from different places, that's fine. Go ahead and type that in the chat roll or the comments. I do review all the comments and glad to connect with you guys and gals out there all across the country. But welcome to the Note Nation Tour Top 40. We're honored to have you guys. We roll into the Phoenix market. Made of a bus horn or something with a virtual bus. But honored to have you guys join us all tonight. Hopefully you're rocking and rolling along here and having a great week and staying safe, staying healthy. That's one of the most important things I guess we could all say for right now. But how did we kind of come to the conclusion of doing this thing virtually? Well, 10 years ago, I sold basically everything I had and started traveling across the country, meeting with real estate investors, attending baseball games and just having a blast. And with everybody being pretty much stuck at home for the most part, thought we'd do it again virtually. So if you're joining us for the first time, hey, welcome to these. We did hit the record button, so you can catch the replays if you've got a bogey on out of here in a few minutes, but we promise to have you out of here in roughly about 55 minutes for the most part. It's what we've been running for the previous cities. So I do encourage questions. I do encourage comments. So if you're watching this, Lynn, Steve, and then we have other people online that are catching the live stream, ask away. As always, you can check out the full lineup at notenationtop40.com for the other scheduled cities on the virtual bus route, as we get to say. So we'd love to have you guys join us, and feel free, like I said, to ask any questions. We get rock and roll. But anyway, let's dive into it because honestly, guys and gals, it is an interesting time frame out there, and Phoenix is actually kind of a little bit of the exception so far to the cities that we've covered already. We do expect to have local and national investors watching this either currently now as we're going live or in the near future. Obviously, existing real estate investors that are doing some amazing things. We also expect to see a lot of new investors here in the next 6 to 12 months as people are like, hey, I got to do something to make some money, honey, because of everything and all the side hustles being shot down and no more Uber, no more Airbnb. A lot of people are looking for ways to make money. And so I think in real estate investing has always been a popular aspect. And we'll go through a little bit of that, why I think it's a great time to be diving into a couple of things tonight. But anyway, we'll talk about statistics and numbers. We'll talk about the second half outlook of 2020. We'll talk about some future opportunities in the Phoenix market, where it's at right now. And then we'll also talk about when and where to get started with some of the newer things that are coming down the pipeline in a few months here. But anyway, if you don't know who I am, I'm Scott Carson, been an active real estate investor since 2002. A very avid baseball fan. I am a little sad that we're having no baseball this year so far, and I don't expect us to have a season, but hey, it is what it is. But definitely over 15, 16 years of mortgage, debt, and finance experience out there. I am the CEO of WeCloseNotes.com, which is our main website for everything, our educational, our deal flow, and stuff like that. I've been teaching real estate investors how to maximize their current markets, honestly, since 2004, but since 2000, just in the distressed debt space. I'm the host of the popular podcast, The Note Closer Show. So if you like podcasts, you can check out The Note Closer Show on any place that you download or listen to podcasts. You can also catch all of our podcasts and a lot of our webinars and replays at WeCloseNotes.tv is our YouTube channel. So subscribe while you're there and watch away. Thousands of videos on there. But I invest all across the country, invested in 30 plus states for our own portfolio. But Austin, Texas is home and has been home for a while. So love it. I love it here. The fact that I'm about 2.5 hours away from just about anywhere in the country for the most part, but that doesn't stop me from buying in other places. Even though Austin, Texas is great, has not been a great real estate investment market. I think it's a little overpriced. But anyway, diving in, let's talk about what the national numbers say. Let's get depressed, huh? I know they're scary sometimes, the numbers out there, but hey, you know what? Let's look at them. There's 11.1 unemployment rate as of last month. That's 1 out of every 9 people is unemployed right now across America. People looking for work, people looking to make some money in some sort of fashion out there. Being laid off is not a fun thing, or furloughed. We'll get to the numbers, what it is in the Phoenix market right now. Basically, across the country, there's 17.8 million people that are unemployed right now. Now, why is that number? I mean, it's a crazy number. We all know that. And it's gotten a little bit better recently, but I think we're going to see some more difficulties coming. They're saying that we expect 52% of small businesses expect to fail. And if it goes beyond another 90 days, we may see an additional 33% jump on that number as well, too, for you. 10% of homeowners. Here's a scary statistic that most of you guys probably don't know if you don't keep your thumb on the pulse like I do. Before all this happened, 1 in 10 Americans were already struggling to stay current. 10% of borrowers were already a month behind roughly on their mortgage out there. So there is a national delinquency rate on mortgages across the platform, about 7.76%, so just under 8%. It's gotten a little bit better, but it's also making it a little bit worse or two for it, because there's 4.1 million Americans currently in default. Now, 17.8 million people unemployed, 4.1 million Americans currently in serious default. I think that number is going to go up. I think we're going to see it in a lot of places start to go through the roof. Phoenix has been pretty good. For the most part, your actually delinquency rate is below the national average, closer to about 5.5% versus a 7.6%, which is actually really nice. It's been pretty good on the residential side of things. But you've got some things that are going to be staring you in the face here before too long. But one of the things I want you guys to consider is, if you think back to 2008, it took us 18 months in 2008 to go from zero to, well, not zero, but to 1.6 million defaults once we started. Okay, it took 18 months from 2008. We are already well beyond that, 2.5 times that in the first, 4 months? So that's why I say we're going to see a lot more defaults than we did 12 years ago. Now, who knows what's going to happen? Are they going to keep kicking the can down the road for everybody? You know, it's hard to say what's going to happen with things kind of blowing up on us here. But there are opportunities in an up, and there's also opportunities in a down market for everybody. And there are still plenty of opportunities out there. Yes, we've done mortgage loan delinquencies record a high spike in 2 years. We've known that. We've been talking that this is going to happen, especially when you look at the breakdown. Non-prime loans, that's the subprime categories they call these things now, had a 21.8% jump in delinquencies in June. Okay, yeah, that's over a year. That's not good. Then you had expanded prime loans charged a second increase, 12.2% rise. Reperforming loans increased by 6.4% default. Prime loan delinquencies rose 5.5%. It's getting worse out there before it's going to get a whole lot better. And we kind of all have to kind of tighten our belts, batten down the hatches, and hang on for this ride that we're about to go through. But what I mean about, Arizona's not looking so bad. If you look at some comparative things, this is the unemployment rate compared out there. You can see that as of April, it was 12.5% of everybody out there for the most part. But now that number has reduced to 8.3%. So Phoenix is actually starting to put people back to work faster than a lot of other places out there. So that's a nice positive thing about the Phoenix market. And I got this from the labor statistics out there. You can see this on any city, any county out there. You can see in going by down, there's a lot of the different things that are hurting in a negative way. Down 6%, down leisure and hospitality. There's no doubt 26.8% down here at the bottom. A little crazy. That's really sad. 1 out of every 4 hospitality workers is basically unemployed. Ooh, ouch. Yeah, not good at all. Not good. That's a sad thing. Anyway, that could be some opportunities there for you. We'll talk a little about that later on there for you. But literally, if you talk about the foreclosure trends in Phoenix, you can see this. We pulled this off a Realty Track for you guys. And the dark blue is where it's 1 in every, just under 2,000 homes. That actually is very, very low compared to some of the other cities. Like we just profiled Chicago earlier, and it was 3 times as worse. Okay, so it was 1 in every 900 homes in Chicago, or in Chicago, Illinois, versus 1 in 1,900. So you should be very happy about that. 85012 is 1 in every 1,900. That's the worst zip code. Top 5 for defaults there for foreclosures there in Arizona. You can see it's kind of all over the map a little bit. You guys know those numbers if you're investing in that neck of the woods. Some good, some bad. You also look at where the foreclosures were roughly. There was auction or bank-owned homes are down quite a bit over the previous month because they put a moratorium. They stopped them for the most part. We all know that. It's no surprise. And you can see how it kind of dropped off. What is interesting is they did increase the auctions. I've only seen this in Phoenix, which is kind of crazy. Auction numbers increased in March, where everything else kind of fell off in March in other cities across the country. So that's kind of an interesting statistic. Those numbers are probably going to continue to decline until we get to the end of the year. Now, you also look at compared the foreclosure filings. You can see what I mean by that. They increased. They were steady January, February. Oh, let's go ahead and get them done in March. And then April and May kind of rolled around. So those numbers are declining as well. Phoenix has been a pretty strong market. We all know this. I mean, if you look back to 2008, it was really on life support. So many California investors, 14,000 REOs were on the market or were ready to go on the market back then. I remember buying homes, $300,000 homes for 30 grand back in the day, okay, and moving those. But what you have to realize is right now in Phoenix, roughly, it's 1 out of 15 borrowers are in default. That's not too bad. It's less than others. It's lower than the national average. It's actually, Arizona has the 9th lowest borrower default rate, which is a positive thing. So you're in the top 20% of lower default rates, which is good. You kind of do have a shorter FHA foreclosure timeframes would be non-judicial. They say 420 days from start to finish. We know that's actually less for the most part. Your traditional foreclosures can be faster there, but obviously they've been delayed right now for a while. We know that with the forbearance agreements that are across the country, including in Arizona, that's going to delay some things for your landlords, for your borrowers, for your people that own the property with tenants in place, people that have owner financed their properties, out-of-state owners specifically from California that have bought in Phoenix and Arizona as well are going to have some struggles to make things. And it's going to be a while before REOs really hit the market. In other parts of the country, we're expecting it to maybe be 18 months, not 18 years. That's a long time for foreclosure, 18 years. I was simply saying that because they're expecting, like in comparison to like Chicago, it could be 4 years before you're able to really take that property back. In Arizona, it's going to be a lot faster than that. We foresee that there's probably in 6 to 9 months, you can start seeing some foreclosures because it is a faster foreclosure state out there. Now, the foreclosure of the pandemic, you can see that the rates on the interest rate loans here, the conventional, the FHAs, the VAs, especially the VA loans here, why is that so high compared to everything else out here? Well, I'll tell you the reason why FHA loans are higher is you have less money down. Usually, you've got somebody a little bit more first-time home buyer. In a lot of cases, especially over the last 12 to 24 months, remember on one of our first slides, I talked about the non-prime stuff. FHA is not considered non-prime, but you have banks that were literally giving the down payment, the 3.5% down on FHA and up to 10 grand towards closing costs. So people are getting the homes with really no skin in the game. Whereas your conventional, your VA loans, you got to put something down for the most part to make some things happen. And all loans together are sitting at that average. And you see it ticking up. It ticked up, ticked down. I think we're going to see an increase in that across the board. The longer people are going through the reserves, going without work, the worse it's going to be, okay? We all know forbearance numbers. They talk about forbearance numbers dropping a little bit. It's still sitting at roughly the 5 million mark across the country. A little bit of a dip, but I think, like I said, once it's going to, the numbers may dip off of that, but when those forbearance agreements stop, the music stops. What happens then? Borrowers have got to show up with their payments. They've got to get back on track in some sort of fashion, and they can't keep kicking the can down the road like the government is doing. So it's really kind of a wait and see on the residential side of things. So let's talk about the commercial side. You got a lot of trouble going on there. We know that that rents are being fought over. People are fighting with the big chains to start paying or not paying. You got bigger companies out there that are really, they've got the reserves, they got the bigger names, but when you look at the small mom and pop, that's where the biggest opportunities, but it's also the biggest hurt. When you look at 52% of small businesses are expected to go under, and that number to increase as we get further into this. It's definitely going to affect a lot of people out there, and that number is going to continue to climb as we see increased numbers. Obviously, the commercial real estate's been booming for a while. I think it's been overpriced for a little while, and we're going to see that across the country. Those numbers drop down, rent signs, availability, rent rates are going to drop as a lot of businesses are reshuffling how they do business, especially in the office space. More retail businesses are going online. Retail spaces are obviously been struggling on life support. Hotel is basically really struggling out there. So let's talk about some of those numbers. Like I said, hotels. If you look at the hotels on any given state, 1 in 5 are in default right now. And some of those are higher. States like Florida, California are really struggling with hotels. Your tourist spots, you're going to have higher default rates, especially in the rural areas, because roughly the vacancy factor is roughly about 30 to 40% across the country right now. That's not a good thing. 1 in 10 retail loans are in default, and that number is going to get worse as bigger stores climb. And then also malls are really struggling to keep tenants in place. Simon Mall, one of the biggest owners of malls, are really struggling, really going after tenants, trying to get them to pay something. Office vacancy. We've got a lot of office in Phoenix, like we do here in Austin and also in San Francisco. 3 of the biggest markets that are struggling with the office rent. Such a glutton of it right now. We expect to see vacancies across the country be at 19.4% nationwide, and that number climbing. It's going to be worse in Phoenix. That's really a couple of the spots. Those 3 things are really affecting Phoenix a little bit worse than some of the other places out there. We expect to see a 15% vacancy increase across retail or restaurant space, with that number climbing to 20-25% by year end and into 2021. We expect rents to fall by 10.5% by year end, and then another 4 to 5% into 2021 as well. So that's the thing you keep in mind. If you're buying commercial properties or you're a commercial investor, you need to look at roughly 80 cents of the dollar of what you'd be getting now as your new number for the new year, and start expecting that, not expecting full market rents. If you're going to be buying a commercial property and there's a long-term tenant in place in there, look at what they've been paying, because you have kind of that, you're between a rock and a hard place. Do I evict somebody who's not paying only to try to get somebody in there that may not be able to get in there right now for a while? Is it going to be vacant for a while? We see that here in Austin. I know we see that there in Phoenix as well. Okay. You've never heard of the billionaire investor Carl Icahn talks about the fact that it's 2008 all over again. He expects this whole bubble. Credit default swaps, the banks did the same thing again, especially in the commercial mortgage-backed security, where we lost $50 billion in market value in the commercial mortgage-backed security market, roughly overnight for the most part in March as things started happening, okay? And he said it's going to be like 2008 all over again. It'll be a whole lot worse. He's shorting stuff, shopping malls, corporate offices. He's been getting rid of that stuff for a while, but he sees that commercial, there'll be some great deals to take care of. If you know what you can do and you know how to capitalize that and how to find those deals, banks are going to be willing to make some deals happen. I'll tell you that right now. You look at what's going on in Phoenix there. Job growth's been high. People wanted to move to Arizona, all right? Kind of shifted overnight. Since commercial real estate, like most facets of the economy, is weakening considerably. Rents are struggling there, just like anything else. And it's the same thing. Office buildings, shopping centers, hotels, and even industrial buildings, you've got a glutton of it in Phoenix, okay? It may take years before those niches really recover. And the thing is here, too, is like we talked about this, large office markets in North America, like Phoenix, 3 worst, San Francisco, and Austin, Texas. So that's one thing I would look at. You realize that if you see that type of opportunity, you know what the market's doing. I wouldn't be buying any office space unless you can get it for a nickel for the most part. And that's not in a bad way. You're just going to have to get creative. A lot of commercial investors are structuring their deals a little bit differently and looking at properties that they can pivot with. They may be taking an empty grocery store or an empty big box store and turning it into a climate-controlled self-storage unit, or taking a different piece of land and making it simple where you're going to be storage, or larger office buildings with a big staff where they've outsourced that now, where people are now working from home, shrinking it down just to make pure administrative staff, maybe working from executive office space. You know, there's a lot of things that you can do. You just got to be prepared to obviously, hey, get creative, and then know that, if you are into it, you're going to have to probably figure out lower, not think best of the market. You're going to have to probably think more bare necessities not overdoing things. So where are the opportunities? Are we going to see a lot of foreclosures, REOs? Across the country, yeah, but it's going to take a while. We're not going to see REO booms. We're not going to see a lot of stuff, I think, happen in Phoenix for a while. Yeah, will you see some? Of course you will, but it's not going to be as dramatic as other parts. So that means we get excited about fix and flips. Yes and no. I mean, in Phoenix, I've got some friends down there, some realtors are doing a great job with wholesale deals and some other stuff, but it's a pretty tight market still. It's a pretty tight market down there. So you're not really going to probably see any substantial deals for the most part, or big discounts. Rentals, I don't know if I want to be a landlord if my tenants can't pay. For the most part, that's not a good place to be. If rent's going to drop, if people aren't going to pay, and it takes a while to evict, that's not a good thing either. So where's the opportunity lie? Well, that's really in the debt space, buying the mortgage debt and being in the paper game. I know that's different than your fix and flips, but the whole point is deals are starting to fall in people's laps out there for everybody, okay? We're going to see residential notes start taking place probably the first quarter of 2021, because the banks will want to move that off their books, especially the non-performing stuff, before year end, before they have to file the quarterly reports. All right, we're already seeing commercial deals hitting the market. There's a group out of Chicago and California, and where else were they? Houston, Texas, talking about on a previous thing. I just didn't put the slide up here. That in the last couple of weeks, they've seen more deals, great deals, come across their desk than they saw all of last year. So a lot of those bigger funds are looking at these bigger deals. Obviously, they're going to gobble up the most, but there is a facet out there, a niche, and that value of $2.5 million or less that the big boys don't want. Okay. So, and there's plenty of banks that have taken those types of commercial properties, whatever type of asset classes, they're in that $2.5 million or less mark. But hey, they'd like to keep them on their books if they could, and they're willing to work with debt investors. They buy the note, take it over in receivership, and operate that either as an owner occupant or taking it over and working something out with the existing tenants, if it makes sense. So keep that in mind. There's a wealth of opportunity, not just in Phoenix in the niche, but all across the country as well. A lot of people talk about apartments, and there's a lot of hoteliers out there, hotels, decent hotels, nice hotels that are struggling, obviously 30, 40% occupancies. 1 out of 5 is in default. Well, what can you do with that? Well, you got to get creative. It's basically a residential property. You just got to tweak it a little bit. So this is a great example. This is a company out of Arlington that took this this hotel and turned it into an apartment complex at Arlington Heights, Illinois. I would take a look at it, Google it. It's a beautiful job they did, and they're getting leased up from 549 square feet up to 1,900 square feet. So they got a variety of 1 beds to 2 beds. It's a brilliant strategy. Why not do it? Why not make lemonade out of lemons? Our buddy Garrison Gilbert out of Maryland's doing the same thing as well. This is in Pennsylvania. He's looking at this deal, actually. Sorry. Taking a 55-room hotel, and they're turning it into 40 2-bedroom apartments and doing a great job with it. And I love what he's doing with this. There are a lot of small mom and pop hotels out there all across the country that were built in the last couple of years, and we're going to see a glutton of that on the market for a while, especially, I would say, the next 12 to 18 months, as people are going to be scared to travel. It's going to take a while for people to come back. If they don't have the money to travel and they're scared of getting sick, they're not going to travel. And you might as well take an opportunity there and pivot that asset and probably pick it up at a pretty decent steal. Now, are the banks in trouble? Of course they're banks in trouble. We all know this. They're not really disclosing this yet, but it could be as bad as it was in 2008 with hundreds of banks being in trouble. Bauer Financial is a bank rating service that ranks banks based on a variety of things. They also evaluate credit unions. We pull it just solely for the banking side of things. And there are thousands of banks in Arizona, okay? We all know there's thousands of banks all across the country, but there are basically 3 major banks out of our list of 1,800 that have at least 5 or more branches that call Arizona home, the office in Arizona. And between those 3, they've got $90 million in loans. They're at least 3 months or longer in default. Just between 3 banks. There's a lot more that have banks that have branches in Arizona, but these 3 are the big ones. 3% or more of each bank's loans are 90 days past due. That number is increasing. They got over $10 million plus in single family homes alone in default. That may not seem like a lot, but between just those 3 banks, that's quite a bit. Now, Western Alliance Bank has over 5 million plus in defaults. Okay. Not the biggest of banks, but hey, they've got some stuff. If they're a smaller bank with a few branches, then what do you expect? Arizona Bank and Trust is also about 5 million, 4.9, right at about 5, also in defaults out there on just the residential side. That's not total commercial and other things. That's just on the residential side of banks. They have stuff that's at least 90 days in default. And the thing that we're seeing across the board, banks are starting to build the reserves. Banks are really starting to save, put funds away, pull in their assets because before they can sell notes off, they've got to have some reserves built up. And you're seeing that they're biding their time. And what happens when, especially in commercial notes, most of the time they're financing 70, 75, maybe 80% of value. They don't want to be above like a steady 75, 80% LTV. And we saw this happen with apartments a long time ago. We're going to see it happen again. When market values drop and the loan to value goes above that mark, the bank is going to go and do capital calls. Say, hey, you got $5 million, you got $10 million, you got 5%, 10% to get us back to the right LTV that we need to be at. No, you're in default. We saw it happen 12 years ago, and we're going to see it happen again, already in the works to happen. Now, that means a lot of opportunities for you guys to pick up some deals at substantial discounts to be able to do some things. All right. So why should you be looking at buying distressed debt? Scott, isn't that a bad idea? Why aren't we just going to be stepping into the bank's shoes and having to deal with the same issues all over again? Yes and no. Yes, you'll be stepping into the bank's shoes. And will you have distressed borrowers? Yes. But the thing about distressed debt is you can start buying that now. There's no reason to wait 12, 18 months to start waiting for foreclosures to show up. The fact that you buy this debt at significant discounts depends on the location, the foreclosure time frame, values, condition, what's going on in the market. That gives you a lot of flexibility when you buy an asset at 30, 40, 50 cents of as is value. That's a lot of flexibility to be able to modify that loan, to do a forbearance agreement, to work with your tenant if it's a commercial property, to provide something instead of nothing, help them get back on their feet. You know, purchasing the debt, you can take and control the asset back. In a lot of cases, in that $1 million plus mark, a lot of times banks will work with debt buyers to allow them to turn that into a new loan if they're going to take over control of the asset. That's why I say that $1 million to $2.5 million leads to a lot of opportunity for people to make some great money and great investments when it comes to the commercial debt space by buying the debt at a discount and then working to take and control that asset. That's cash flow. And there's all sorts of strategies. There's 10, 11 different strategies. Loan reinstatement, modification, short sales, short payoffs, foreclosures, loan sales, deed loans, whatever. There's a whole lot of options you can offer to borrowers that can be a win-win situation. Take over the note if you need to. And if they're not going to work with you, hey, take it over in receivership. That's one of the beautiful things about commercial debt is you have the right to start collecting rents, if there is any, if the borrower doesn't play ball, or if the borrower is robbing from Peter to pay Paul, which we'll see and we are seeing currently right now. It's not a good situation. I'm willing to work with people, but not everybody is willing to work with the bank and the borrowers and things. Okay, and that's the thing. Take over the property if you need to, and do what you want. Keep it, turn it into an asset, turn it into a property you own, an REO, or keep it as a note for cash flow. There's a variety of things you can do. Some advantages about note investing, especially that are very relevant at this time. So many real estate investors get used to the direct mail aspect. Oh, I got to drop out postcards or yellow letters, or I got to do all this marketing. We don't mail postcards or letters. And most real estate investors, when they're doing direct mail, they're hoping to get one borrower or somebody, 1 to 4% response rate, to call them. Hey, I got a deal, singular. Okay. And then they got to do the whole thing all over again next month. And with foreclosures, you got all these investors buying the foreclosure list and mailing out postcards and direct mail and drive-bys. Ugh. We don't do any of that in the note investing side when we're targeting banks and asset managers. We're targeting banks and asset managers to provide a list of deals, not a deal. Okay. If you got email which all of you should have an email address. You can mark it to a professional email. It's not hard to get. LinkedIn profile, and you don't mind picking up the phone and dialing for dollars or reaching out to people online, you can do this. You can become a note investor relatively easily. One source leads to regular deals on a regular flow, quarterly, monthly. I've got some banks that send me quarterly lists for 3, 5, 10 years. Okay. And that's the beautiful thing. I cherry pick the best deals for our own portfolio. You can do the same thing too. You don't have to buy it all. Hey, you make an offer on a deal and it doesn't turn out to be what you want, walk away from it. Next, you don't have to do skinny deals. If you want to take down some bulk deals and can bring investors together and do it legally, great. You're going to get better pricing and even better results. Now's the time to be buying, whether it's you're looking for residential or commercial assets. When everything started like it did 12 years ago, I started on the commercial note space, started buying from Capital One, Wells Fargo Multifamily, US Bank, and a whole bunch of Citizens Bank. There's a bunch of banks that I bought commercial notes from first before the residential tsunami hit. The residential wave where I was picking up stuff then at nickels. And are we going to see nickels and dime trading? I don't think so. We're going to see substantial discounts. But right now where the market is you have all these people hold the debt. They don't want to take too big a discount. And you've got a lot of investors out there that want a big discount. And so over time, that divide is going to come closer and closer together. Now, what do you do? Will you wait around for that? Or do you start honing your skills and start making your arrangements? Start building a team and honing your craft in the next 60 or 90 days when that market comes. Because if you wait till that, then it's too late. If you wait 60 days, 90 days, you wait till the end of the year to start learning something, you're already lapsed from everybody else that's starting to take advantage of stuff. So, and yes, you guys don't have to have your own capital. There are plenty of investors out there to fund your purchases. Now, think about this. In 2010, there's peak of the foreclosure time frame then was 15 million homeowners were underwater. 15 million homeowners were underwater in 2010. We're going to see pretty close to that number again. We're already getting pretty close. Are they going to be underwater? I don't know, but a lot of investors have overpaid for assets. If you don't have at least 20% equity in your property, you're going to be probably underwater. Whether it's your primary residence or investment property. Think about that. Now, are there investors out there? Yes. And Phoenix is a hotbed of investors. That right now, across the country, there's $9 trillion in retirement funds out there waiting to be put to work across IRAs, 401ks, a lot of money that needs to be put into the market, just sitting there, not making hardly anything. In Phoenix alone, Phoenix, there are 33,000 investors that have a IRA account. And out of that 33,000, 2/3 of them, 22,000 of them have at least 150 grand or more in their accounts. Okay. That should tell you there's a lot of money there in Phoenix. Okay. Now, if you take in the fact that there are 29,000 real estate investors in Phoenix, that's still a lot of deal or potential buyers for your deals. Plenty of investors to fund your deals and people to buy your deals just in Phoenix alone. Numbers are crazy across different parts of the country as you see things. And that's what I love about the note business is yes, if you're working with a bank, yes, you can try to target local assets, but oftentimes they're going to have a whole list of deals across the country that you can move and market. And that's part of the reason that we're doing a lot of these webinars. We want to feature markets. We want to identify investors in specific cities across the country that we can look to move those assets to when we get them in. Because we're already starting to get them in. 10 years ago, when I started traveling, that was one of the beautiful things. I thought I would take 30 weeks to travel the country to hit all the Major League Baseball parks and some fun. It turned into 3.5, 4 years of nonstop travel and working with investors and banks across the country. We're going to see that again. Now, do you want to be the banker or do you want to be another borrower waiting around hoping that they don't evict you? I'll tell you right now, I want to be the bank because the bank always wins. The bank is always going to win. And that's what a lot of investors don't understand. If you're not the bank, you're not in the primo position. If you're a wholesaler, you're at the very end of the chain waiting thing. If you're the bank, you're at the top. You're as close to the deal flow as it happens. If you're a fix and flipper and REO, you're waiting down for everything to filter through. Most of the deals that we see never even hit the foreclosure markets, or we see deals 6 to 12 months ahead of most investors because we're looking at the debt. We're talking with the banks. And yes, banks will sell debt. Okay, that's how you can tap in the tsunami. And I've been teaching investors since 2010 about notes. Actually, been teaching investors working with investors since 2004. but focused solely on debt and notes investing since 2010. I've helped thousands of investors purchase their first non-performing note. And that's been a beautiful thing. It's one of the things I get most joyous about. It's not only the fact that I've helped thousands, but I've helped thousands of borrowers as well. And that's really what the United States needs. It needs us as real estate investors to have the ability to come in and pull people out of a bad hole, to give them a hand up, to help them out of this bad situation. It's a lot of bad is happening to good people right now. Sickness, job layoffs, forbearance, defaults. Not their fault. Well, okay, maybe it was the people before who were in default a little bit, but it's not their fault. It's gotten bad. And us as investors have the opportunity to really dive in and do some great good by creating win-win-win scenarios. Win for us and our investors, win for the banks, getting the stuff off their books, and a win for the borrowers by being able to say, hey, you're not a bad person. I'll work with you. And you know what that does? When you save somebody from foreclosure, it also saves their neighbors. It also saves the block. It also saves the zip codes. Because for every foreclosure, it reduces the property values in the neighborhood, in the neighbors, in the streets. So the more you can keep stuff without going to foreclosure, you're stabilizing the neighborhoods and really, as I like to say, making America great again, one defaulted borrower at a time. You have the opportunity to do that in the note game. If you're a fix and flipper and you're buying a foreclosure, you drive the value down for a short period of time, and sometimes a long period of time. It all depends on how soon the market's going to recover. And yes, you can do this with residential commercial notes. Whether you're looking for cash flow or asset growth, there's a lot of things you can do. Some people want to just hold notes and cash flow. That's great. Other people, hey, I want to take some notes down in particular areas of the country that I can keep and turn into rentals. I can turn them into assets for a while. That's great. Do it. You can do this on a one-off basis. You can do it in bulk. A lot of the banks are going to be like, hey, please buy something. Now, look, the big boys, we all know they're going to gobble up a lot of stuff, but they can't take it all. There's going to be a lot of crumbs, and the people that are going to be hurt the most are your smaller banks, your regional banks that can't sell the stuff off, but also investors like you and me that overpaid for assets. They owner finance their property, and their borrowers are defaulting on things. There's a lot of opportunity for us to come in and really help things. Your small mom and pop borrowers that have a smaller property, they don't have the reserves. Honestly, 85, 87% of Americans are one missed paycheck away from being in default on a variety of bases. And we're seeing that happen. That's why I think the numbers are going to get a lot worse before they get better. And you guys have the opportunity to jump in there and do a lot of good if you want to. And we've done trades for as little as less than 25 grand, but 25 to 5 million plus in the last 10 plus years. Okay. And no, bank doesn't look at your credit. They don't care what your credit is. So I don't care if you've been through a bad divorce, short sales, been your own deadbeat borrower. Don't care if you can't even pay your mortgage right now. You don't need your own funds, and you don't need to have good credit. The bank just cares that the money shows up. And there's so much money sitting out there. So many investors looking for deals. They just need somebody to reach out and say, hey, I got a deal. Because if you've got a deal, good deals will find good money. And money is really cheap right now for you to be able to negotiate so that it's a true win-win across the board. So like I said, if you are a 21st century investor and you've got an email address, you got a LinkedIn profile where you can, why LinkedIn's so important? Because you can contact banks that way very easily, whether it's via phone if you want to. You don't have to jump on the phone if you don't want to, but hey, it's an opportunity for you. So whatever your focus is, what asset class, single family, multifamily, apartments, hotels, retail office, self-storage, big box, industrial, mobile home parks, whatever it is, there are deals to be had in every sinking asset class out there. You can create win-win scenarios. We talk about this all the time. And just think about that. It's great to make money, but it's even better when you can do some good and you can help that borrower out and really, really change America. Martin Luther King says, I have a dream. Well, I have a dream. I'd love to help 10,000 Americans stay in their house. I'm not going to be able to buy 10,000 loans, but I can help create 10,000 investors that can go and buy one deal or two deals or three deals or 100 deals and can start impacting America like we did for this couple right here. This is in South Beloit, Illinois. We bought in Phoenix. We bought all across the country, but this is a great story. Lived in the house for 18 years, refinanced their house, took a little cash out to fix up their house and put some kids through school and stuff like that, get a new car because their old truck was busted up. And then the market crashed where they were at. They'd lived in this house forever. They weren't bad people. Husband got sick, was out of work, market crash. When this note came across our table, across my desk with a bunch of others, I'm flipping through it. I see, by looking at the collateral, this borrower's been trying to do a loan mod for 4 years. 4 years she's been trying to do a loan mod. Loan had been sold multiple times. Every time she'd taken the time to scan her bank statements, to scan her income, to write a hardship letter, to pull her tax returns and fax them in, and then also ship them into the bank, hoping the bank would work with her, hoping she would be able to do something. 4 years. Can you imagine that? 4 years of hardship trying to stay in their house, trying to save their dream home. We saw it. Bank that we bought this from offered up at just a cheap price. We were picking up for 33 cents of what she owed. Actually, 20 cents on the dollar of what she owed, but 33% of the value. I immediately called her, called the bar. She goes, listen, hey, I see that I'm your new bank. She was like, oh, the note's been sold again. I'm like, listen, I see that you've been trying to do a loan mod. Let's come to an agreement right now. Can you start paying your existing payment? Yes. Okay, great. Can you bring a little bit of money to the table? Not asking for all 4 years. If you need to bring, yes, I can bring some money. Okay, great. Could you pay a little bit extra each month? Yes. Okay, let's do that. You do that for 12 months. We'll drop your interest rate to 0. We'll set it up so every dollar you pay goes towards your principal, and you'll have this house paid off in less than 8 years. Less than 8 years versus 33 or 30 plus years. Now, the beautiful thing is they did it. With our helping them, we got 2 months ago, I got a payoff demand. It was just like they owed like 3 months left and they paid it all off. Can you imagine the feeling of paying that off, of the ups and downs of that lady? What Sheila and William have gone through and their 3 daughters that they've raised their house, the stress and how that has been just washed away. There's a lot of Americans out there that could use that help. 17 million homeowners. 17 million people unemployed, worrying about the shoe dropping. You have the opportunity to help them. Maybe not today, maybe not tomorrow, but in the near future if you really want to help them and be able to make some good money doing it. And you can do it big or small if you want to. My buddy Gene here out of Elkhart, Indiana, great guy. I've known him for several years now. When he first became a student of ours, he was buying a single asset, doing a little flip here, there, working full-time as a hot shot truck driver, was driving stuff all across Indiana and Chicago. I got a text message from him the other day. Says, hey, I've done amazing in the note business because of what you taught me. I've got a fund actually of 13 million invested. I'm closing on my 150th or 170th asset. He's actually changed his life by putting it to work. Not to get rich quick, but doing the things and showing up every day, doing the same things, marketing, looking at deals, raising capital from other investors, and going out making things happen. Laura Blanc, one of our rock stars, absolutely amazing what she's done. First year in the business, she bought 2 notes with her own money because that's what she had. And finally, I got it through her head, like, listen, go raise capital. And she went immediately and then raised capital for 14 notes. Basically, in the next year, in that second year, she closed on about 75 deals. She just moved from Wimberley, Texas to Maryland, is moving into her dream house, a house that she's always wanted to move into as a kid. She's not a kid anymore, but she's still young at heart. But she's also working on closing on a deal of 100 assets in like 20 different states, a $4 million trade with other people's money. That's a beautiful thing. It's a life-changing, it's a generation-changing thing, not only for herself, but her 2 boys. All right? Keith Collins is an amazing individual out of Mason, Ohio. Ex-mayor, I think, in Mason's around Ohio. I've done for years of working in city government, but also building water treatment plants, dabbled in investing. But when he got into the note space, he really found his calling for that. And he sent me an email about a month and a half, 2 months ago, saying that him and his wife are going to be making 7 figures this year because of what they learned from our teachings. They learned how to do it. We teach them how to do it. No, some of the deals they bought through us, but we taught them how to go find their own deals. And they've done an amazing job. We're so proud. That's great. I love these stories. We got hundreds and hundreds of stories, but I get so proud of people that don't have real estate experience, that don't really have the hard knock stuff of life, and they have less reserves, have less resources. And that's why I'm so proud of Raphael here. Raphael's out of San Diego, California, a budding entrepreneur. He ran a car detailing company there for several years, 15 employees. But when the Corona came, They just shut his business down. Nobody wants to drive, and they sure as heck don't want to pay somebody to come detail their car that they could do themselves to occupy their time. Luckily for Rafael, he started learning the note business in December. In his first 60 days, he bought 5 notes. 2 of them he got him immediately reperforming. The other 3, 2 out of 3, he's in the process of selling now and making a profit, a sizable profit, a great ROI for his own funds. But he's also started raising capital because he's like, oh, I can do this. I don't have all the money I need, but I've got friends around San Diego, I've got friends around me I can talk to, and they see the deals. They see that the numbers make sense. And that's the beautiful thing, guys and gals out there. The numbers make sense. You can bike up an asset at 50% of what's owed and at 50% of value. It's hard to go wrong on that, even if you got to hold on to it for 12 to 18 months to make things happen. It's still, what's going to happen 12 to 18 months? The market's going to recover, or the market's going to be strong, or it's going to get a whole lot cheaper. And we've helped a lot of people really dive into the note space. I mean, like I said, we've helped hundreds and hundreds and hundreds of real estate investors tap into the note business and learn how to do this and take it on and do amazing things with their spare time, or turn into a full-time thing after a while. This, like I said, it's not a get rich quick. It's a build wealth, and it takes time. You got to learn some things. You got to approach it differently than the fix and flip. It's not an HGTV kind of thing, but where did all these people learn? Hey, they learn from our trainings. And now I'm not here to sell you on a 3-day workshop or a home study course or anything like that. I just want you to invite you to stick your foot in the water. And that's why we've put together, for the last few months, we host a training called Note Weekend. And what it is a 1-day training class with yours truly. No, I don't sit here and blow smoke up your butt. I sit here and teach you the Cliff Notes version of note investing. I have to give Bill Griesper, my buddy in Columbus, a shout out for saying, Scott, that's the Cliff Notes version of note investing. You take it all and make it really easy. I'm like, okay, we'll call it that. I think Cliff Notes is taken, but we'll just say it's the Cliff Notes. But it's a 1-day training. We kick off at 9 a.m., usually Central Standard Time, but depends on who we have in there. But we'll run from 9 a.m. to roughly 3, 4 o'clock in the afternoon. Take a couple breaks. If you go to noteweekend.com, you can actually see the full schedule, the tentative schedule for each time that we do it. And it varies. It's different every time because we know the markets are changing out there. Across the country, they're changing. You need to know different things and different statistics and different numbers and different approaches and different markets and where to dive into and what not to dive into. And so our next one upcoming is July 25th. And like I said, it's a 1-day online via Zoom like this. It's recorded. Watch on Saturday. Miss parts of Saturday, don't worry about it. We restream it on Sunday. Usually get the replays out by Sunday morning or Sunday evening. So you can watch those replays. You can download those videos if you need to do and catch them later on if you've got family. Like I said, it's Cliff Notes. It's usually $99. We have dropped the price to $49. Hey, I want those that are serious about it. And I have a goal, a big goal to have and help and teach 10,000 new note investors to really change America here and have a big dramatic impact in the next 6 months. And I think I can do it. I'm going to start off with this. And one of the great things is I'm a big believer that, hey, if this doesn't suit you, like, hey, it's not I don't like it, Scott. Hey, no problem. I'll refund your money back. No questions asked. And I'll throw in another thing in there. I like to call banks. And so last month I did a 4-hour call blitz of calling bank asset managers. We're going to do the same thing again. I only charge $49 for that 4-hour training. We're going to throw that in there as a bonus for signing up for Note Weekend. You'll get the replays as well. And then some other bonuses. You get a 20-page manual with some other videos and other training to watch with some of the vendors. We go through a lot in the 1 day. All right. And like I said, it's not a pitch fest. It's literally me sharing the truth, showing you how to find the right people, what to say, what not to say. And it's a great way, like I said, to dip your toes in the water, see if that water's warm enough for you to dive in. And for many people, it is. Our next one is July 25th. The one after that, if you can't make the July 25th one, is August 29th. Saturday, we'll have one in September or October. Haven't decided yet because we're waiting to see what the market does. We may have a full 3-day class. Our 3-day class, you can apply that $49 towards the cost of that as well, included. So what we cover, we'll show you how to, where and when and how to find the note deals. We'll talk to you about how to fund these deals with OPM. We'll show you how some of the ways to structure it. We'll talk about the different exit strategies, the funding, how to make some money on that fund flip. Sorry, how to make money with the different exit strategies. We'll talk about the different vendors and teammates that you need to look at to start structuring your business, start putting things in place for you. We'll also share with you some of the different loan trading platforms that you start looking at assets today That's right. You start looking at residential commercial assets today. You ain't got to wait 6 months. We'll share with you some platforms you can look at, start diving and getting your feet wet today. Okay. And then we'll also go through a lot more things. I say we run until 3, 4, 5. It all depends on the questions that you want. Usually the last hour, we open it up for networking and do a visual networking, which is kind of a cool thing. People share where they're at, what they're looking for, their target. So it gives you an opportunity to know other students. We've got a great private Facebook group called Note Nation. About 900 of our students are a part of that. It's a great way to ask questions, network with others. And then I always encourage everybody to check out our podcast, the Note Closers Show, and then also our videos on YouTube at WeCloseNotes.com. So go to noteweekend.com. That's where you would sign up for it. We would love to have you guys and gals out there. And like I said, it's all for just $49. Trust me, it's the cheapest, but the biggest bang for your buck. And I deliver. And you, like I said, you'll get a manual. You take that with you, download it, download the videos, take this with you. It's all here to help you on a Saturday with me. If you're stuck at home, what the hell else are you going to do? Might as well jump on and learn something. And if anything, trust me, you'll walk away with a better knowledge of the distressed note space, and it'll make you more educated as not only as an investor, but as an individual. If you've got friends in struggling or other people that are in default, hey, it gives you an opportunity to help those out as well. And you do some good. So love to have you be a part of it, everybody. Like I said, if you go to noteweekend.com, that is the website to get signed up for it. I want to open it up for any Q&A right now, whether it's here on the Zoom or on Facebook. Here to help you guys understand, and I'm glad to any questions you have, be glad to answer that for you guys. So what questions do you have that I can answer for you? I foresee, I mean, honestly, if somebody wanted to get in and do some really serious damage, you could buy 100 assets in the next year. Totally could do that. You probably have to look at a couple different markets. Phoenix is great. You're probably not going to see as big a discount on the real estate there because it is a faster foreclosure state. It's a very desirable state like Texas is. On the residential side, I think you've got a bigger bang for the buck with the commercial notes in Phoenix and some other places around there as well. That's where I think the biggest opportunities lie in the Arizona markets. But you're going to have some other areas. I mean, there's going to be distressed assets everywhere. I mean, Scottsdale, you're going to see some stuff there. Oh my God, I can't even think what's up north of Arizona. I'm just struggling here. When is the next Note Camp? Well, Note Camp we only do once a year, Stephen. So we did that a month ago. Note Camp is not we only do that once a year. Note Camp is our online 3-day or 4-day basic conference. So Note Camp we did that last month. We won't do that again until June of next year. Our 3-day virtual note buying workshop will probably be in September is when we're looking at the next 3-day workshop. So that's different. Note Camp's our online summit. Our virtual note buying workshop is a true 3 days nuts and bolts workshop. And then like I said, Note Weekend we do monthly. So. Let's see if we got any questions here. Looks like we've got. All right. If there is not any other questions, I want to thank you all for watching tonight. Thank you for jumping in and spending an hour with me. Where we at 53 minutes, something like that. I'm getting down this, like I said, let you get back to your evening. So once again, guys, go to noteweekend.com. I would love to have you guys be a part of it. Like I said, we've got some big goals and there's a lot of opportunity coming down the pipeline. Time to get ready is now. If you keep procrastinating and wait until, I'll get to it later, you know what? Somebody's going to blow past you. And those that are taking opportunity will be 60, 90 days ahead. In some cases, that's all they need. So if you're struggling right now, hey, I get it. That's why we make it affordable. Make it very affordable for you to tap into this. And there's a lot of information out there, a lot of great deals to be had. And it might as well be you buying it versus somebody else. So I want to thank you again for watching. Join us online here tonight. If you missed part of it, join us late. We'll have the replay up tomorrow for you guys as well, as always. You can catch all our replays at WeCloseNotes.tv, and we look forward to seeing everybody at the top. Thank you.